Quarter two is where tax firms can see the biggest revenue growth of the year. But most tax firms just let off the gas. You just survived tax season. You're ready to exhale. You're telling yourself you earned a break. And while you're taking that break, May, June, July become the months you missed the single biggest needle mover opportunity in your firm today. You miss it. This is a pattern. You see, you run hard from January 1 through April 15th, you finish the rush, you exhale, you tell yourself you earned it, and then 3 months go by and your revenue line stays flat because that's just the way it has always been, David. Most firms just take a break, David, because this is how we remember it to always be forever and ever, David. See, if you're a firm owner who's making $200,000, $500,000, million plus dollars in revenue, and you think your problem right now is that you need to get new clients, or your pricing is off, or maybe you think it's just the way it is and it's always supposed to be that way, just flat, all of which can probably be true. But what I'm proposing is the one thing that no one talks about in the tax industry: the dark season. The dark season is what happens when you treat quarter two like a recovery period instead of a growth period. When you let extensions drift instead of pulling them forward, when you stop marketing because you think you need a break, when you miss the exact window when advisory conversations should be happening because returns are still open. This is the dark season. I've spent the last 18 years in the tax industry. The first 12 of those years, I relaxed after April 15th, acting like I had gone into surgery and I needed a few weeks of recovery. I ran a firm with thousands of clients, and I can tell you this: I did not realize until year 13 the impact that quarter two could be to my business. That's when I started the path from 7 to 8 figures. In this video, I'm gonna walk you through four specific things. 1, why the extension habit is costing you more than you think. 2, why advisory deals die when returns are still open. 3, how to pull revenue forward from quarters 3 and 4 back into quarter 2. And number 4, how to get your firm to actually do the work instead of resisting it. This is the exact approach I have taught to over 1,200 tax firm owners. And the ones who have run this right, they have had the biggest growth in quarter 2 in their firm's history. Let me show you how. Number 1, the extension habit is yours, not your client's. Most extensions are not filed because the client is not ready. They are filed because you are tired. Think about the last few weeks of tax season. March 15th, April 15th, you're running on fumes. A client calls and says they're still waiting on a form like a K-1, a 1099, or a form they swear they have not gotten just yet. You say, hey, let's just file an extension. We'll get to that later. We'll get to it before the deadline. See, I did this for years inside my own firm, thousands of returns a year, and at the end of every single April, I would look at a stack of extensions and tell myself, these clients need more time, when they did not really need it. Most of them had everything they needed. I would even file automatic extensions on my client's behalf because I just didn't want to do the work. I would assume that they weren't ready. I would file an extension and I would just send an email or a message and I'd say, hey, just so you know, I'm letting you know, I'm gonna file an extension for you. We'll get to the deadline. Don't worry, you now have till October to procrastinate. The forms that they were waiting on were sitting in their inbox. You and I both know that. They had already paid their estimated payments. There was no pain. There was no reason to push. The real person who wanted to file the extension was me and my team because we were exhausted and we wanted to relax and recover from the weeks of tax season hell. When you file that extension, you are not moving a deadline. You are moving revenue. You are taking money that should have hit your account in April and you're pushing it all the way till September and even October. And you're doing it with 20 to 30% of your book of business, and probably 80% of that 20 or 30% are the ideal clients who want to pay you more for tax advisory. Let me give you a quick example of a firm that I recently worked with that had this problem. This firm had roughly about 1,000 clients and 40% of them filed an extension. That's 400 returns whose revenue was pushed back to the second and third quarter. The average fee for their returns was $500. So that's roughly $200,000 they voluntarily moved 6 months into the future. every year. For years they've done this. They created a cash collection problem on purpose. Here's your homework. Pull up your extension list for the last year. Write down the total number of returns that went on extension and multiply it by your average return fee. That number is the revenue you've moved from Q2 to Q3 and Q4, and that is what the habit is costing you today. All right, number 2, you cannot sell advisory on an unfiled return. Advisory dies the minute the client remembers the return is still open. Close the loop first. What does that mean, David? Finish the freaking return. Get the job done. I've watched firm owners try to do this the wrong way for years. They go to a client in June with their extension. They try to open a conversation about advisory. Hey, I have identified that there's this tax savings opportunity. I have this strategy. And then they say, we are going to help you save a lot of money on your taxes. And here's what this looks like. And the client says one of the following 3 things. Here it is. Number 1, they say, that sounds great. Aren't you already going to do this for me anyways? Or they say, can we go back and do this last year? Or let's finish the return first and then we can talk about it. All 3 of these kill any deals. The first makes them feel ripped off. The second one sends backwards prior year signals that they can't even change. So they're like, can you use this strategy on last year? Because I don't really want to pay taxes. And the third one pushes the conversation to October. And now what? The urgency is gone. I call this closing the loop. You cannot sell what comes next until you have delivered on what came before it. Most firm owners think that the problem is that they're bad at sales or customers won't pay, but they are trying to sell on top of an open compliance filing problem. There is no version of that conversation that works. The open return sits in the middle of the table and every attempt to offer advisory bounces off of it. Every client on extension is a client you cannot upgrade. They are sitting in the holding pattern where you cannot ask for more revenue, you cannot expand the engagement, you cannot convert them to advisory. The extension is not just a delayed return. It's a locked door that you can't get into. And that's where the revenue is hiding. All right, here's your homework. Look at the list you just pulled. Next to each name, write the annual fee you're earning from that client. Now, write what you think the advisory fee could be if you were on a full program with this client. That gap in revenue is what's behind that locked door. That is what we need to identify right now so that we can pull that revenue forward and start making money in Q2. All right, number 3, pull revenue forward on purpose. The firms growing the fastest do not wait for revenue to arrive. They go get it. Here's what I started doing inside of my own firm and what I now teach to every tax firm that I work with. Stop thinking about Q2 as the recovery quarter. Start thinking about it as a collection quarter. Take your extension list, set a target. You do not need 100% of those to file in Q2. You do not even need 80% of them. Start with 50%. If 400 clients were supposed to file an extension, you're going to bring 200 of them during May, June, and July. How? You reach out, you call them, you send a specific email, you tell them, hey, I want to finish up this return in the next 30 days. And here's the time that I have blocked out to meet with you. You stop letting them drift and you start running a schedule to get people on your calendar. That alone changes your entire year. But this is where it gets powerful. The second those returns are done, you open an advisory conversation. That loop is closed, like I mentioned. You do it while there's still time left in the year to implement tax strategies, which means the client actually sees tax savings this year, not next year. Now look at what this does to your calendar. If you pull 200 returns forward into Q2, what did you just do to Q3 and Q4? You freed up your calendar. Most firms stop marketing on the second half of the year because they have no capacity. They're busy. The team is drowning in extensions. There is no room to bring on new clients. So they turn the acquisition machine off from August to December and wonder why their growth is flat. Let me show you the math. Say you have 100 extensions. You move 50 of them into Q2. You just created space for 50 new clients. At an average $15,000 annual engagement fee, that is $750,000 in new revenue not ever touched before. Plus, you pull the compliance revenue you were waiting on in the third and the fourth quarter too. Quarter two becomes the new catalyst of growth this year. Now here's your homework. This week, look at your extension list and set a target to close 25% of them each month in the second quarter. I know that might not happen. The target has to be high enough so you get maybe 80% of your extensions filed. This is the first motion. Start with the target, see if it works, and then scale it up. All right, number 4, pay for performance, not production. If you ask your team to pull revenue forward without changing how they get paid, they will not do it, and they shouldn't. Every firm owner I have worked with has run into this challenge, this wall. They build up a quarter two plan, you sit down with your team, you explain to them the strategy, and one of 3 things is gonna happen. Everyone nods their head politely and nothing changes. Or the top performer pushes back and says, this is not what I signed up for. Man, dude, I'm better than this. Or you get a quiet quarter where everyone works the same as they usually did and extensions slide into September and October just like they did every other year. Here's why. You ask them to change their behavior without changing their reward. Think about it this way. Everybody loves their favorite station. It's called WIIFM. What's in it for me? Most accounting firms still pay a bonus at the end of the year using their job as the marker. If you do your job, you get paid, plus a little bonus for doing okay. This is not an incentive. This is a participation trophy in a world that people don't need that anymore. When I built the advisory side of my firm, I stopped rewarding production and I started rewarding performance. Production is how many returns they touched or filed. Performance is whether they hit the target for the quarter, and that could be revenue. Production rewards are for those showing up. Performance rewards for moving a specific number. If the target is 200 extensions closed in quarter two and the team hits it, the bonus pays. If they miss it, it does not. Everyone on the team knows exactly what they need to do and what they're working towards, and that is exactly what's going to get them to hit that goal. I commonly see firms that are doing over $500,000 stuck in production bonuses. They're rewarding people for doing their job. Firms that are usually doing less than $2 million are rewarding their teams based on production. Firms over $2 million have figured it out. They're generating their revenue, they're focusing on targets, and they're rewarding performance, not production. This is not a coincidence. Your team is not lazy. They are responding exactly to the way that you pay them to respond. Change the pay structure and the behavior will follow. You will get your results. So here's your homework. Sit down this week and write down 2 numbers. Number 1, write down the revenue target for quarter 2 if you pull those returns forward. Number 2, write down the exact bonus your team gets if they hit it. Then put it in front of the team and tell them this is how we are running this quarter. You will feel the energy in the firm shift that same week from the people who said that they weren't going to do it to now saying, I want to, I must, and I have to do this. The growth is not external from your business. It is not in some new marketing channel. It is not in some new software. It is not in more clients. It's in the extensions that you've already filed. It's in the advisory conversations that you're not having because the returns are still open. It is in the revenue that you are sitting on for quarters 3 and 4 that needs to be hit in May. It is in the capacity that is burning you out in August that you should have used in May, June, and July. Quarter 2 is not a break. It is the quarter your firm was built to grow in. And every year you treat it as a recovery period is a year you gave away the growth on purpose. If you want help running this inside of your firm, click on the link in the description. If you want to know how to compensate your team fairly, what bonus structure to have, if you want to know how to get those extensions to move forward, what language to use or what scripts you need to follow in order to get those emails to your clients and help your team push them across the finish line sooner than later, go down below, click on the link in the description, book a call with me and my team so we can show you how Tax Maverick can help you offer high-ticket advisory for $12,000, $15,000, $20,000, or even $30,000 per client, but more importantly, start pushing revenue forward so that you can have the best quarter 2 and the best year ever.